Well, the Globex market hit 77 and change, just a couple points above yesterday's high. We have resistance all around up here. The 70 area is resistance, the 90 area is resistance, the 1400 area is resistance. So we'll keep an eye on this area today. We're going to sell the 72.75s. Our stop is, there's a volume cluster up around the 73s, which is above us a little bit, which worries me. Usually the B period likes to take out the A period high by a bit sometimes. Looking at February 27th now is a slightly different picture. There's selling clusters all over the place on the 27th. Get one here. We have selling clusters 79, 78, 80, 82, 90, all over. So we're going to put our stop sort of strange 73, 75. Placing the stops is always challenging. We'll put the stop above the 8 period high. Actually, you know what? Let's take a look at the Globex high here. 77. Let's put our stop at 78. 78 is our stop. Our target, there's some volume clusters from yesterday down around the 59 area. That's where the F, G, H, I, and J period. One of these days I'll run down what periods. I mean, I start the A period at 9:30. Each period is half an hour that I refer to, so you can follow the scale. A through N goes from 9:30 to 6:15. But anyway, there was a volume cluster down at 58, 59, 50, 57, 58, 59. That would be the initial target. With the opening at the high of the day, this looks like it could be an opening drive day. If in fact the B period doesn't take out the A period high and makes a lower low, and the C period doesn't take out the B period high and makes a lower low, we might adjust that exit at 59 to even lower. There's volume clusters down at 52, there's a volume cluster down at 46, and of course the gap's all the way down at 22. So we'll keep an eye on all of those factors. And the NYSE tick is building negative volume after the regression channel rose all day yesterday.
Activity to strengthen in the second half of the year, in part as the result of stimulative monetary and fiscal policies.
The market's moving in the right direction as Bernanke speaks here.
Proceed at or a little above its sustainable pace in 2009, bolstered by a stabilization of housing activity, albeit at low levels, and gradually improving financial conditions. However, in light of the recent turbulence in financial markets, the uncertainty attending this forecast is quite high, and the risks remain to the downside. Inflation has also been a source of concern. The price index for personal consumption expenditures rose 3.4% over the 12 months ending in February, up from 2.3% over the preceding 12-month period. To a large extent, this pickup in inflation has been the result of sharp increases in the prices of crude oil, agricultural products, and other globally traded commodities. Additionally, the decline in the foreign exchange value of the dollar has boosted some non-commodity import prices and thus contributed to inflation. However, the so-called core rate of inflation, that is inflation excluding food and energy prices, has edged down recently after firming somewhat late last year. We expect inflation to moderate in coming quarters. That expectation is based in part on futures markets' indications of a leveling out of prices for oil and other commodities, and is consistent with our projection that global growth, and thus the demand for commodities, will slow somewhat during this period. And, as I noted, we project an easing of pressures on resource utilization. However, some indicators of inflation expectations have risen, and overall uncertainty about the inflation outlook has increased. It will be necessary to continue to monitor inflation developments carefully in the months ahead. I turn now to the Federal Reserve's policy responses to these financial and economic developments. Well-functioning financial markets are essential for the efficacy of monetary policy and indeed for economic growth and stability. To improve market liquidity and market functioning, and consistent with its role as the nation's central bank, the Federal Reserve has supplemented its long-standing discount window by establishing 3 new facilities for lending to depository institutions and primary dealers. The lending facilities now in place offer depository institutions and primary dealers 2 complementary alternatives for meeting funding needs. One pair of facilities, the discount window for depository institutions and the primary dealer credit facility for primary dealers, offers daily access to variable amounts of funding at the initiative of the borrowing institution. A second pair of facilities, the term auction facility for depository institutions and the term securities lending facility for primary dealers, makes available predetermined aggregate amounts of longer-term funding on pre-announced dates, with the interest rate and the distribution of the awards across institutions being determined by competitive auction. Although these facilities operate through depository institutions and primary dealers, they are designed to support the broad financial markets and the economy by facilitating the provision of liquidity by those institutions to their customers and counterparties. The primary dealer credit facility was put in place in the wake of the near failure of Bear Stearns, a large investment bank. On March 13th, Bear Stearns advised the Federal Reserve and other government agencies, via the Securities and Exchange Commission, that its liquidity position had significantly deteriorated and they would have to file for Chapter 11
I guess no one's allowed to fail in a free market,
alternative sources of funds
God,
available.
I mean, it's amazing. How do you have a free market unless you're allowed to fail?
Policy. Normally, the market
You can't have a free market unless somebody fails.
And that is as it should be. However, the issues raised here extended well beyond the fate of one company.
Yeah, the
Our
entire
financial
banking
system
system's
is extremely
screwed.
complex and interconnected, and Bear Stearns participated extensively in a range of critical markets.
So does every other
With financial
bank.
conditions fragile, the sudden failure of Bear Stearns likely would have led to a chaotic unwinding of positions in those markets and could have severely shaken confidence.
Good.
The company's failure could also have cast doubt on the financial positions of some of Bear Stearns' thousands of counterparties.
What about when Volcker did the right thing and let interest rates go to 18%? It created the bull market for the next 25 years.
Financial system. The damage caused by default by Bear Stearns could have been severe and extremely difficult to contain. Moreover, the adverse effects would not have been confined to the financial system, but would have been felt broadly.
Boy, what happens when more and more of these suckers fail?
Asset
That's the
values
scary
and credit
part.
availability. To prevent a disorderly failure,
Everything will be
Bear Stearns,
nationalized.
and unpredictable but likely severe consequences
my,
of
prophecy.
such a failure for market functioning and the broader economy. The Federal Reserve, in close consultation with the Treasury Department, agreed to provide funding to Bear Stearns through J.P. Morgan Chase.
We'll pause video here.
Don't you feel there is a
Old Ben doesn't seem to be sounding very reassuring.
to prevent systemic risk?
Excuse me.
It's appropriate to do for a large investment bank. Isn't it just as appropriate to do it in the housing market? Because that also as a whole, presents systemic risk issues. Look forward.
We're tempted to get out of this position and look for a re-entry. We'll see what it does right here at the 7125 area. If it pauses here, we'll stay in this position. If not, we'll take a point or so and look for a re-entry. We're right at the second standard deviation on the NSY chart. We'll build this volume here. So we could be safe in this.
On the housing loans that's being proposed, you didn't mention that.
I don't want to micromanage the position.
You mentioned a series of items you support. You didn't mention that.
Well, with Ben speaking, you never know what these guys
the impact of that legislation on the housing market.
Well, there are arguments on both sides in that case.
Point out to you, I've been traveling around my state.
We're going to get out at 71.
Number of companies
Out
are
at 71.
hiring people that are based on
We'll look for a re-entry.
manufacturing, a lot of
Well, Senator Schumer mentioned the financial.
We'll see if we build any volume in this time period, but we're out. Took just a point and change. We're now trading 4 contracts first day we're doing that.
The
And we'll look to see what the where the C period opens up and what the volume's like up here on a retest of the A period high, 72 to actually 72 to 73.
I think we all agree that there's going to be quite a bit of